Hello, everyone. Looks like we've still got quite a few people trickling in here, but we're going to go ahead and get started because it is 3 o'clock and we want to be respectful of your time. So just to give you a little background on who we are as Molen Associates, we're a tax and accounting firm. We were formed in 1980 in Houston, Texas. So we service everything from individuals, small businesses, medium-sized businesses. We do a lot of self-employed contractors. So real estate agents, you fit everywhere in there in between. We do everything from tax preparation, bookkeeping, IRS representation. So if it comes to small businesses, small business ownership, we're there to help you. The purpose of this webinar is to go over the One Big Beautiful Bill. So if you notice on the registration page, we have 3 different webinars. Today's is specifically for real estate and realtor focused. That doesn't mean if you're a business owner or an individual, you won't get value from today, but this one's primarily focused on real estate agents. So if you're not, like I said, feel free to stay on. But if you want to get one focused specifically for individuals or business owners, there's 2 other ones if you go to that URL. So starting out with, what is the One Big Beautiful Bill? It is basically a piece of legislation that is the biggest piece of tax reform since the Tax Cuts and Jobs Act of 2017. So it's very large. There's a lot that has changed. A lot of it is really continuations of the Tax Cuts and Jobs Act. So it is kind of the rule book for, it's not just replacing what the tax code is, but some of it's changing, some of it's extending. So make sure you know what these rules are, so that way you can continue to play. If the rules change, you don't want to be playing chess when you could be playing checkers, or vice versa. So this is very, very narrowly passed. The House passed it by 1 vote, and then the Senate made it even closer. They made it 50-50, so the vice president had to come in. They had to vote on it, and then Trump signed it into bill. This tax reform isn't just for the wealthy. So you've probably heard in the media, there's a lot of, this is very beneficial for the ultra wealthy. It's cutting tax for the rich. That's really not the case. From everything we've read, this is super helpful to all different income style or income ranges, from those that are more poverty levels to more middle income or even high income phase outs. There's really benefits for each different demographic. So it is true, if you're in the higher income range, you probably are saving more in taxes, but that's just because your tax rates are higher percentages. But really, it is beneficial across the board. I want to introduce myself and Kathy Stump, who is the co-presenter here with me. I am the COO of Molen Associates. So I generally meet with the new business owners coming into the firm, get to know them, help them understand who we are, our processes, and then fit them with the best advisor. Kathy Stump is a CPA, and she is our tax services manager, as well as kind of our accounting specialist. So she is really the one that knows this bill inside and out. She has been studying it very in depth for the last 2-3 weeks since it was passed on July 4th. We like to think of this as the legislative iceberg. So what we're going to talk about today is really just the very tip above the surface. There is so much more below the surface. It really is a massive bill. Every time there's tax and legislation changes, there are changes that come years down the road that maybe it's unintended consequences or loopholes that change different economic situations. So the key with the One Big Beautiful Bill is be proactive. Learn as much as you can up front, so that way you can take advantage of it. Good tax planning starts now. So this is kind of your first step. You can learn what is out there to know what applies to you. So make sure you have the right team in place. Do you have a good banker? Do you have an attorney? Do you have an accountant, a financial planner? If you have good relationships with each one of those, you can successfully set up your business to where you can make those pivots as the legislation changes. So if you don't, now is your call to action to get those people in place. As realtors specifically, you are the trusted expert for your clients. So you should be the go-to when they've got questions about, oh, what do I do for this? Do you have a painter? Do you have a banker? How does this apply to my real estate house? So there's so many different questions, and you really are their trusted expert. You want to build a relationship they can depend on, not just be a transactional resource. So the success of your business depends on how well you provide value to your customers. Let us be your secret sauce. We can be your tax advisor, your accountant, kind of in your back pocket. If you have questions and you want to know how this impacts not only your business, but your clients, let us know. We're happy to answer questions. For most real estate agents, 60% of your future transactions come from your centers of influence and your past clients. So the better you can service them with kind of a good understanding of how this tax law can impact them as real estate investors or even just residential homeowners, this can be hugely beneficial to you, but also your clients. So as we go through the webinar, we're going to come up with a couple of different surveys and questions. These will just be kind of sporadic throughout it. We just want to see where your baseline is at, what you guys are understanding, if you have any questions, and if there's anything we need to follow up with later. So I'm going to start with one of these, if I can pull it up. So feel free to participate in the poll. We just want to get a baseline of where you're at with your understanding and changes with the OBBB. So I'll leave that up there for just 1 to 2 minutes. And then as I wait for you guys to respond here, you'll notice in the webinar, there's a function at the bottom. I believe it says Q&A. Mine's different. I think it said Q&A on your side. Feel free to ask questions. We may not get to them during the presentation, but we will allow for some time at the end to answer those. If we find a good question, like, oh, we should cover that, we may stop and answer it then. If we can't get to all of your questions, we'll try to answer them afterwards. Sometimes the questions you guys ask may be too specific or may need more additional context. So feel free to put them in there. We're happy to answer them. Even if we can't cover them now, we'll try to get to them after the webinar as well. So for that first poll, there's the results. It looks like most people are not confident. Few people are somewhat confident, but no one is very confident. So perfect place for you to be here. The next one, let's see if I can go back over here. How do you normally stay informed about major tax law changes? Do you go to a trusted advisor? Do you go to a professional source like irs.gov? Do you do your own research? Do you go to news outlets? Do you use TikTok? Awesome. So on that one, it's kind of an interesting result, a little bit spread throughout. Okay, and I'll do one more here. What is your biggest challenge with tax planning? Is it hardest for you to understand what the tax deductions are, keeping up with deadlines, organizing your records, planning for estimates? Awesome. So that one's pretty much split. A lot of people for estimates and understanding elections, but really is pretty split across the board. That's pretty interesting. Okay, so moving on to our first topic. The way we're going to structure this is we're going to start with some of the business deductions, and then we'll go into more individual deductions. So starting with the businesses, the biggest one is business depreciation. Kathy, do you want to kick us off on this one?
Sure. Business depreciation, of course, is one of the biggest deductions that anyone with any kind of equipment-heavy businesses or investment-type properties as well. The timing of business depreciation matters. It also is a big deduction that was heavily debated. We've talked to our clients over the past year about the possibility of the bonus depreciation going away. You'll have noticed over the last 2 or 3 years, it's been steadily declining and was set to sunset at the end of 25, which meant after 25, you would no longer be able to take advantage of the bonus depreciation. The nice thing about bonus depreciation and the biggest benefit of it is it gives you some timing ability. You can decide whether to take it or not. It's not a one-time election. You can decide year by year, like 1 year you can utilize bonus depreciation and the next year you may decide that you don't want to use it, and that helps you with kind of spreading out your income and taking advantage of other sections of the tax code depending on where you are as far as taxable income. The other thing is comparing the benefits of 179. Section 179 is also an automatic expense type of mechanism that's been around for a long, long time. The coordination between the two is important. You can do some Section 179 and some bonus in a certain year. But depending on what you're looking at, bonus depreciation can take you into a loss, where Section 179 cannot. So it's important to look at that year to year and know that that is something that you need to really kind of plan for when you're looking at toward the end of the year. We never recommend that you go out and buy something just to get a deduction, but if you're going to need it anyway and your timing could be this year or next year, it's really important to look at that for the end of this year to make sure that, okay, if I'm going to need it in the next year or so and I've got a tax liability this year, it gives you that planning opportunity. The other thing that's really important and often overlooked is succession and estate planning. If you're looking at the overall value of your estate, that is a good way to decrease the value of your estate if that's the goal. You do want to make sure that you're kind of making wise decisions, though, on depreciation and not make it just your tax liability, because there's other deductions and credits and things that we'll talk about later in the seminar about how we balance those things out. But bonus depreciation at least gives you some control over that and makes it where it's a little bit more your decision based on rather than just the decision of, oh, this is how the forms turned out.
Yeah, so as Kathy mentioned, a lot of realtors will see you guys have very cyclical income, or some years it's very high, others it's very low. Maybe one year you got 400,000 in production, the other you have 100. It's just a bad year for some reason. So maybe you want to buy a vehicle. Well, you don't want to bonus depreciate that vehicle in a year where you only have $100,000 of income if you think the next year you're going to have 400. So that's a great way to reduce your taxable income in a very high income year. But planning for future sales here, if you plan to buy that vehicle and then you plan on reselling it in 3 years, beware of depreciation recapture, because you don't want to have to be paying taxes on something 24 months later and just forgetting about it. So there's a lot you can do here. Like Kathy said, balancing out 179 versus bonus depreciation. It's not an either or. Sometimes you want to use one, sometimes you use the other. Sorry, I shouldn't say it's not an either or. You should be doing either or for a certain asset, but you can use them both for different strategies. Kathy, you want to cover real estate professional status? You're still on mute.
Real estate professional status is a status that obviously real estate professionals can qualify for. It's more for people that are in the business full-time, not just as a part-time venture or as a side gig. There are certain qualifications. You do have to have more than 750 hours of service in a real property trade or business during the year. And then also the other restriction that sometimes kind of kicks out people that are not full-time realtors or full-time real estate investors is that you have to have more than 50% of your total personal services time must be in real estate activities, development, construction, leasing, brokerage, etc. Material participation in each rental category as well. That anything that you're involved in, that you're materially participating in, you're making decisions, you're kind of running the show. When you talk about rental income, there's two different kinds. If you're a real estate professional, you can take advantage of some of the things that are just ordinary income and not passive income. real estate commissions, rentals, if you're qualified, subject to SE tax though if it's earned income. Loss deductions are not capped in this situation. Passive, most rentals for non-real estate professionals, and no SE tax, but passive loss rules apply. And this is where cost segregation can be a big, and it's a kind of a depreciation issue, but also it's a kind of its own separate thing. And it can help you have that, if you have that real estate professional designation, then it can help you utilize your real estate losses, and it converts a part of your investment in long-term assets like, buildings, apartment buildings, any kind of rental real estate that have very long depreciation lives. If you do the cost segregation route, you can take certain components of that building that you purchased and make them not only a shorter life, but also subject to our bonus depreciation. And I think with that, are we going to introduce Mr. Brody?
Yes. So we've got Tom Brody on with us. So we can report cost segregation on the tax returns. We help with the strategies around it. But Tom Brody is actually one of our preferred partners to do the actual study. This is a very high compliance. It's very technical. We focus on what we specialize in. He specializes in his, but we work together when it comes to cost segregation. So Tom, if you're available, I'm going to let you present for a minute. Feel free to take 2 to 3 minutes, and we'd love to hear maybe not how cost segregation has changed, but with these new tax laws, how it can be utilized for real estate agents, but also primarily investors. Looks like he is connecting right now. Sorry, just give him one more minute. Looks like it's still spinning. There we go.
All right. Sorry about that. So
no worries.
What I wanted to do, I'm a national account rep with Cost Segregation Services, and this is what we do full time. So what I want to do is go in a little bit about what cost segregation really is. And as we mentioned before, it's all about depreciating assets, right? Depreciating buildings. So what cost segregation is, it looks at buildings a little bit differently. So okay, there we go. So building lives normally come in 2 different ways. Either a 39-year life, which that's for retail spaces, office, hotels, Airbnbs, or 27.5 years, which is single family rentals and multifamily. So what normally happens, they put all that cost into one bucket, if you will. What cost segregation does is break that bucket into faster depreciating assets, as we mentioned before. It's either building structure, tangible personal property, leasehold improvement, or land improvements. Once those things are broken down like that, then you can apply a different process and different tax features. This one, we talked about bonus depreciation. Hit next. It's these things in the green box. Go back one, sorry. These things in the green box is what bonus depreciation is all about. The building's actual structure is not going to be accelerated. These things in the green box is what gets accelerated. So when you're talking about bonus depreciation, you're not taking all your depreciation. It's just these things that are non-structural that can be depreciated faster. Okay, next slide. Just to give you an example of what one looks like, go ahead next. Hit next too. Typical building, 2-story building, million, had owned it, from 2018 to 2020. So they're going to be doing a straight line depreciation of $338,000. When we did the study, broke it down, applied bonus, hit next. Everything in that green box now is what could be depreciated in the current tax year. So you're looking at over a $2 million depreciation versus $338,000. So big difference, tremendous help to cash flow because you're just writing these things off sooner. Next slide. Now, the one thing we talked about bonus depreciation, and they mentioned how that was the Tax Cut and Jobs Act was going to be phased out. So with the one big beautiful bill, it brings back 100% bonus, but only for things starting in 25. So if it's a new building that's been purchased after January 19th of 25, it's 100%. So essentially January 20th and beyond. If it was purchased or put into service before that, like the first part of the month in 25, it's at 40%, which is part of that phasing out that was happening in the one big beautiful bill. This has become permanent. So 100% bonus is a permanent feature now, which is going to be very helpful for people that are buying real estate. So if you're realtors and you have people that are getting ready to buy a building, this is one thing you want to tell them, is that this makes a lot of sense because now it's really going to help you as far as your cash flow early on. Now, the other thing, the one I wanted to talk about is that you can actually go back and look at a study and apply cost segregation after the fact. So in this case, it's when a building is built, not when it's studied, that determines the bonus rate. So for instance, if you had a building that you bought in 2020, but you didn't find out about cost segregation, you didn't study it until 2024, you bought it in 2020, that's part of the original 100% bonus rate. And so you can go back and claim that 100% bonus now. Hit the next. The one thing that's going to be different is that this look back study, you can unlock it. You can lock that depreciation even though you didn't apply it when you first bought the building. And the great thing is the IRS will let you take the differential from what you should have claimed versus what you have recorded as depreciation and record that in the current tax year. So you don't have to amend previous year's returns. There's a thing called the change of accounting form that you can apply in the current tax year. So you're not affecting previous year's returns. Go ahead, next slide. Now, the one thing we talked about, the real estate professional status and passive income. In this case, to say you have several buildings or you have a client that has several buildings, next, and they're actually getting, go ahead, next, from all of that rental income is really passive. And what you could do is say you had some buildings, you could do a cost seg on one of the buildings, and the savings from that cost segregation study is going to offset all your rental income from all sources, not just the one that you did the study on. Hit the next slide. With the real estate professional status, go ahead and go through. This is when we talked about active income. So all of the things that you're doing as a real estate professional status, whether it's rental income, property management fees, real estate development fees, other real estate activities, that's all active. You do a cost seg on one of your buildings, that savings is going to offset that active income. And there's no limit into how much you can actually have that affected. So the great thing about a portfolio is that you can do one study on one building, and that's going to offset your total income from the portfolio, not just the income from that one building. And hit next. That's all I was going to cover here. If anyone has any questions or wants to get an estimate on a building to find out what cost segregation can do for you, this is my contact information. This QR code will actually put my contact information in your phone. So I'd love to hear from you. We do free estimates. So if you've got someone or if you have a property that you want to get evaluated, we can do that free of charge. I'd be more than happy to help you out. So Clark, thanks very much for having me on, and sorry for the delay in getting connected.
Clark's still muted, but thank you very much, Tom. I would have to say that we used Tom for quite some time, and he's done a really good job for us and for our clients. So if you've got questions further about this, he's a great resource.
Perfect. Thank you. So one other thing to note for cost segregation is it's really not part of the One Big Beautiful Bill, but I mean, going back a couple of slides, right here, we would have been at 40%. So going from 40% to 100% is really the reason we're talking about this. So it's bonus depreciation of 179 that make this that much more powerful. So real estate investors, they thought they were going to get, sure, it's still a valid strategy, but now it's a very, very powerful strategy. Their buying power is now that much higher increase. I mean, interest rates are still pretty high. Maybe their returns might not be great, but if they can finance it and then do a bonus depreciation, they may get quite a bit back in taxes, or maybe they can cash some money out, or they can put it into another investment. Their money can work harder for them. So one thing you'll notice as we go through here, there's quite a bit of real estate tax law changes, and that's really because President Trump he's a real estate guy. So it's very much a common thread as throughout the One Big Beautiful Bill. That is really it for the cost for depreciation between 179 and bonus depreciation. If you have any questions, once again, please put them in the question and answer, and we will get to those. The next section is QBI, section 199A. This is also not new, but it's kind of the unsung hero of the One Big Beautiful Bill. It doesn't sound fancy. There's not really anything crazy about it, but this is a huge thing for small business owners, and each one of you as a realtor is a small business owner. You are receiving commissions, and then on those commissions, so you have your revenue minus expenses equals your profit. On that profit, QBI gives you a 20% deduction without spending any additional money. You're getting a 20% cut on your taxes for any business income. So whether you're a Schedule C, a partnership, an 1120S, you receive this 20% deduction. So if you're making $100,000, you're essentially taking a $20,000 reduction in income for tax purposes. You can still take the money out, it's yours. So this is huge for small businesses that this is continued. It was originally scheduled to sunset. So Tom mentioned in his portion that bonus depreciation is now permanent. By permanent, what we mean is legislation has now said that it will no longer sunset. A lot of tax laws are scheduled to start and stop at certain dates. For example, bonus depreciation starts at 100% on January 20th, and it will go forever. So it doesn't mean it is truly permanent. Congress can still change it. There may be tax law changes down the road, but at this time, it is no longer scheduled to sunset, which is a good thing for tax planning. Another thing to mention here, there is now a minimum floor of $400. Not very big, but this means that ultra small businesses doing, let's call it $1,000 to $2,000 of profit in a year, still get this deduction, and it's more than they would have gotten before. So not horrible. A couple of other notes. This is good if you happen to be a C Corp, it may be time to review your entity. We had a lot of C Corp owners wanting to stay as a corporation rather than switching to an 1120S because of the QBI phase out. So now that's not in place. They may want to switch to an S Corp. This can also allow for a little bit more breathing room. So if you're going to be doing retirement contributions, if you're deferring income, things like that, this is, like I said at the beginning, this is an iceberg. We may talk about each of the individual strategies, but it's really when they're used together that they're the most powerful. So for example, you may want to bonus depreciate in a certain year, but that's going to lower your income. So you don't want to lower it too much if you're going to plan on QBI. Or if you're planning on getting these other credits and deductions that have income phase-out limits, you want to watch those phase-out limits to make sure you can. So it's just this balancing act of 4 or 5 different strategies to make sure you can deploy all of them. So this is kind of my reminder here. You can balance out bonus depreciation, section 179, with QBI. So if you bonus depreciate, let's say you got $200,000 of net income, you buy a new vehicle, and that puts you at 150, that means your QBI will also be lower. So you're reducing your deduction because you have lower profit. So it's just make sure you're calculating that when you're doing your tax planning. Another note on a lot of these aspects is state conformity. So in Texas, we don't have income state taxes. So we generally don't have to worry about state conformity, but a lot of other states do, specifically California, New York. I think most of the people on this webinar, I recognize your names. You're located in Texas. You really don't have to worry about it. But for those people I don't know, if you're coming from out of state, please check with your tax advisor, check with us. A lot of these do have state conformity rules that it may not apply. Maybe it applies at the federal level, but it does not apply at the state level. Kathy, anything else you have to add on QBI for 199A?
The thing with the state taxes, even if you are not currently, I mean, you live in Texas and you don't have any operations in other states, if you're consulting with maybe investors or clients for yourself that are coming from other states, it's always important to make sure that you consider that they may need some or some state tax level advice, even though they're maybe becoming a resident of Texas or just kind of just a client that you're advising, even though they're not current to your state. The other thing about QBI, I think you'll notice that in all of our conversations over the last year, talking about tax planning and stuff, this was one of the things that we were really pretty concerned about because it had just became a given. Everyone was kind of used to it. Pretty much everyone qualified. You got to take that deduction. And then as we crept closer and closer to that cliff where it was going to be, December 31st of 25, you got it. And then 1/1 of 26, you didn't. It was a big concern, and we made sure that we tried to let clients know, but it was definitely a sigh of relief for us when we figured out that, oh gosh, not only did it stay in, but went back to 100% and is now permanent.
So the next section is Section 1202, Qualified Small Business Stock. Kathy, do you want to keep us going on that one?
And qualified small business stock has been around, another thing that's been around forever. It's kind of pretty largely overlooked by a lot of businesses. There are some compliance things. You have to make sure that you're following all the rules and regulations. Even after it's not a set it and forget it type thing. There's ongoing compliance if you do this. But they have solidified it, made it, a little bit, the rates were pretty good to start with, but now you get a capital gain exclusion up to $15 million, up from, I believe it was $10 million before. It also helps you to kind of have that kind of a long-term growth strategy, that you have this investment and that you're planning for it to grow. And then at the end, when you exit, then that's when you get the benefit of, growing this business that you don't really have to pay taxes on it. It is pretty complicated and has a lot of compliance issues, but we did want to mention it just because it is still there. And it's something that we could advise on if you think that you or your clients could benefit. And this is R&D, research and development. Research and development is probably, you don't think of it as a big thing for realtors or real estate investors, but there are components of the R&D expense deduction that can be utilized for different things. It is another thing that's a little bit complicated. You do have to have some kind of knowledge of how to put it together and make the, make the math work, in other words, and make sure that the documentation is really there and really solid. When it first became, it's been around for decades, but when it first came out, it was kind of loosey-goosey. People would kind of jump in and do it, and, they never, didn't really follow the guidelines, didn't have it documented very well, never really got in trouble, so then they would do it again. They kind of got into in the mid, I guess late 90s, early 20s, started looking into it a little bit more. It was on the IRS Dirty Dozen list for quite some time that, they were really looking into it and kind of targeting it. It's more strict now as far as compliance, but it is still out there and still a good thing to be considering if you are in any kind of a thing that would make you have the availability to do an R&D expense deduction. It's still out there, hasn't went away. So we just wanted to make sure that we touched on that as well.
So now moving on to more of some of the individual strategies. The first one we have is qualified opportunity zones. And this is kind of like that bonus depreciation cost segregation. It really is one of those things that's honestly underutilized. It was set to phase out in 2021. So we kind of got used to it not being there for the last couple of years, but this is one that's coming back in 2027. So basically the way opportunity zones work, any money that you have accrued capital gains on, you can invest it into a new investment, whether it's rural, it needs some work, it has to be a qualified opportunity zone, you get an enhanced step up in basis. So there's the 180-day investment window still applies, but you can defer capital gains for up to 5 years. If you hold it for 5 years or longer, you actually get a 10% step up in basis. If you hold it for 10 years or longer, you actually get a 100% step up in basis. So you avoid those capital gains altogether. And any post deferral gains are also tax-free for up to 30 years. So this is huge. I'm going through an example. If you take $1 million, invest it into a property in 2027, you're talking about $240,000 of taxes, assuming 20% capital gains tax plus 3.8 net investment tax. If you hold it for 10 years, you just save $240,000 in taxes by investing it in another investment, and you can still make more money on top of that. So huge, huge, huge for investor capital. So if you're working with real estate investors, make sure they know about cost segregation, but this should be next on their list. One thing to note, it is a lot harder to qualify for this. There's more mandatory reporting. Also, the eligibility for this is much stricter, but they've made the reporting, the improvement requirements are down to 50%. So it is easier to do if you do qualify. So that's just a couple notes there. One other thing to note on this, wait till 2027. It does exist in a form or fashion from now until 2027, but it's not as beneficial. It's a little bit more muddy. So if you plan on purchasing property and you want to do an opportunity zone in the next, call it 18 months, talk with a tax professional, see how this applies. But this could be huge. If you have any business, any gains, real estate investments, you want to roll it over, you can still 1031 it, but opportunity zones are a way to not just defer the taxes, but to completely avoid them.
The other nice thing about opportunity zones that's kind of out there, it's going to be more under the control of the states as to what is designated as an opportunity zone. And one of the things that they have mentioned is that anyone that's got, federally declared disaster areas like Beryl in Texas last year, if those can be, that's in our local area. So if you don't want to go, far outside of your area, there is a possibility that Texas could designate some of the Beryl disaster zones as opportunity zones and give you an opportunity to invest in your local economy.
Perfect. Okay, the next grouping is SALT cap. So SALT stands for state and local tax. In Texas, we don't have income tax like we've stated, but we do have very high property taxes. A lot of other states have high property taxes or high income taxes. So in the last few years, it's been a $10,000 cap. So meaning if you own a house and you're paying $15,000, $20,000 in property taxes, you can only claim $10,000 of that as a deduction on your taxes. So now this is up to $40,000. So, and this is one that is set to phase out by 2029. It is not permanent, but think of this as a leaky bucket. You want to plug as many holes as you can. You make that capital work for you in the short term to build wealth in the long term. There are phase out limits for incomes over $500,000. But even above $500,000, it doesn't reduce the amount below the original $10,000 of SALT cap. So you're never worse off than before, but for incomes under $500,000 for the next 4 years, you can claim up to $40,000 in state and local taxes. So if you have high property taxes, high income taxes, super helpful. Going through an example here. So we put I did a increase of income of 100,000 from 5 to 600,000 to show you the importance of this. And this is going back to pulling in bonus depreciation, cost segregation, all these other strategies that we said, hey, if you fluctuate your income, there's certain ways you can time it. You can defer income. It's not always tax deferral. Sometimes you truly can avoid taxes. So if your AGI, your adjusted gross income is 500,000, if let's say you got it down to 500 because you bonus depreciated, but your income would have been 600, your SALT deduction goes from 40 down to 10. So you lost $30,000 of deduction. Your taxes went up by $45,000. So you earned 100,000 more, your taxes almost went up by 50%. So this is something really, really important to watch for as you near those limits. If you're anywhere near 500, watch your retirement distributions, watch your QBI, all of that. You really, really want to be paying attention to make sure you're working with a tax professional and making sure everything correlates together. Because I would not want to be making a retirement distribution and paying 50% tax on it. So be very careful when it comes to that. This is also something to mention for your clients if they're buying a personal home. If they're worried, maybe it's a $500,000 house, property taxes, let's call it $15,000 for round numbers. Maybe before they would have to pay all of it in property taxes and then they only get so much deduction. This is a way that they can get more benefit on their taxes to free up some cash flow, even for their primary residence. So that's super helpful as well. Couple other deductions. So now we're moving to 4 different deductions or 4 different components of the one big beautiful bill on each slide, just because there's not a lot of meat to these, but they're still very important. The new standard deduction. So this is another one where it doesn't sound that exciting. It's only going up by, call it $1,000 from 2024 to 2025. I think it's $1,200 for married filing joint. But the biggest thing to remember is the old standard deduction set in 2016, it almost doubled going into the Tax Cuts and Jobs Act. So it was, I think it was $12,000 in 2016. It went up to roughly 24,000 in that year. So it went up very, very high. So it's going to continue at that level. It's going to stay at 31,500 for married filing joint, 15,750 for single filers, and then index for the future. So this is permanent. We can now plan on that higher standard deduction, which is, like I said, these are not all strategies just for the ultra wealthy. This impacts all taxpayers, anyone that files a tax return. Most people nowadays are doing the standard deduction. We used to have a lot more itemized filers previously. With the tax rates, once again, those were scheduled to sunset, but they are now made permanent. So 2 notes here. The tax brackets themselves, the 10%, 12%, 22, 24, those were reduced back in 2017 with the Tax Cuts and Jobs Act. So now those lower rates are made permanent, but they're now going to be indexed for inflation. So assuming you have the same income this year compared to last year, your taxes are going to reduce. So we almost had a post-2025 tax hike, but that is no longer going to happen because they're locked in and indexed for inflation, made permanent. So that's, once again, great for a lot of taxpayers. Child tax credit. Kathy, did you have something on that one?
Not specifically the child tax credits, but the standard deduction becoming permanent and the rates being locked in is something that we've also talked to clients about all throughout the year in tax appointments that, kind of be ready. There could be changes. For the longest time, this was debated, of course, very hotly. And we really couldn't have any concrete guidance or, advice to give people, but we were trying to make sure that you did know that a change was coming and we just didn't know what it was. But this is really huge because this was set to sunset at the end of 25, which they call it a cliff. You get to the end of 25 and boom, you're right back to the way it was before the Tax Cuts and Jobs Act. So it's really something that's been around for a while, and just kind of like QBI, you kind of became used to it. And it's like, oh, well, this is what it is. And if we hadn't had the one big beautiful bill, these rates could have gone up, and also our standard deduction could have gone down. And that's the big thing that really is a takeaway, that it does affect all taxpayers. It's not just high, super wealthy taxpayers. This affects everyone.
Perfect. So going on to the child tax credit, I want to explain the difference between a credit and a deduction. So a credit is a dollar for dollar savings on tax. So meaning if you, let's say you make $100,000 of income as a business owner, if you spend $100 on, let's say, a business meal, taking someone out to lunch, actually that's a bad example. Let's go, you're spending $100 on some marketing materials. You get to deduct that $100 on your taxes. You're left with $99,900 of profit. So you have to pay taxes on that profit, meaning you're going to be, let's call it 15% taxes. You pay roughly $15,000. With a credit, it offsets the tax directly. It's not just a deduction on your income, but after you've calculated tax, you get to then remove tax directly. So even though it's only a $200 increase per kid, this is huge because it's roughly worth, for some people, that's a $2,000 deduction in income to offset that much tax. So pretty substantial for a fairly minimal impact. I'm sorry, pretty major impact for a pretty minimal change. So that's per child. It's also indexed annually, so we should see that increase year over year with inflation. So maybe it's 2.2 thousand this year, maybe it's 2250 next year, as an example. We still don't know 2026, but those will, as inflation rates come out, we should know those values. As far as itemized deductions, this one's it's not going to impact a lot of people unless you're in the 37% tax bracket. They are going to cap the itemized deduction limitation. So you essentially get a 2/37 reduction in your itemized deductions. So if you happen to be in that bracket, feel free to let us know if you have any questions. But just want to mention, if you are, there are some changes there. The extra senior tax credit, or tax deduction, not credit. There was a lot of confusion with this one. Even though Social Security Office put out an email to, I think, 60 million Americans saying, hey, you're no longer going to have to pay taxes on Social Security. That is not true. That was not passed. It does not happen. You will have to pay taxes on Social Security just like you were before, up to 85%. The taxes, the laws there didn't change. This came into play as a $6,000 deduction against your income for anyone over 65. So if you are over 65, your spouse is over 65, you can get 2 of these. But there are phase-out limits of $75,000 and $150,000 for married filing joint. So this is essentially their attempt at reducing taxes on people who would be receiving Social Security income, but it is not a direct impact on Social Security taxes. Come over here to the right, charitable deductions for non-itemizers. So you can deduct $1,000 as a single filer or $2,000 as a married filing joint filer on charitable contributions, even if you don't itemize. So generally, if you donate to a church or a charity, you have to hit that threshold. Remember that standard deduction we talked about? If you're not hitting that threshold for standard deduction, previously you could not claim your deductions. They're just kind of lost. It's already covered by that standard deduction. Now what they're saying is, even if you don't itemize, you can still get $1,000 or $2,000 deduction for those contributions. There's also a 0.5% floor, which can be helpful. For tips and overtime, this one, we will see how they report it. I'm really interested to see what comes out in the next 6 months on how they want employers to report it between tips and overtime. So up to $25,000 in tips and $12,500 on overtime as a single filer, double that for married filing joint. So for restaurant industries, this could be huge for your employees. It's essentially giving them a raise without changing anything in their compensation because they will pay less in taxes for their exact same income. So once again, we don't have a lot of clarity on how this is going to be reported, what the requirements are, how it's going to be restricted, but hopefully we'll get some more guidance there. But it was made official, so good for restaurants or anyone working in tips and overtime industries. For auto vehicles or loan interest, For U.S. assembled vehicles purchased between 2025 and 2028, you can deduct up to $10,000 per year for U.S. assembled car loans. So there are phase-out limits for this, but this is a nice way you can deduct some of that interest. It probably goes hand in hand with the tariffs, what they're trying to do there. They're trying to move a lot of things to the U.S. So that's another note there, bringing the political side into the taxes. Trump accounts is another pretty big one. So these are for children born between 2025 and 2028. So according to our research, they should be automatically opened for any newborn who has a Social Security number and is filed on a tax return, and they'll get $1,000 deposited into that account. Parents can then contribute an additional $5,000 per year tax deferred, which means it will grow tax-free, but when you distribute it, you then pay the taxes on it. Very similar to a traditional IRA. So it's just another investment vehicle that new parents can use for their children. So a couple other notes on the Trump tax accounts. By age 18, after the age of 18, if you can take out 50% of it for qualified expenses. After age 25, you can then take out 100% of it for qualified expenses, but after age 30, the funds can be used for any reason. So once again, it's just like a traditional IRA where you have to pay taxes on it, on those gains, but non-qualified expenses. So if you take something out for something that doesn't qualify as an expense, it will be taxed as ordinary income. So you want to avoid that. Oh, plus a penalty. So you want to avoid that as much as possible, but it could be a really good investment vehicle for parents. Oops. Mortgage interest and casualty deductions. So this one, it essentially limits it. The $750,000 mortgage interest limit and suspension of casualty loss deductions are now made permanent. So that threshold is not going to be reduced again. For 529 plans, they have increased the amount as well as what qualifies for eligible expenses. So there's a lot of other programs outside of college, post-secondary. So for example, accountants, there's a huge accounting shortage, not a lot of CPAs coming in. If you want to pay for a certificate, if you want to become a financial planner, 529s can be now used for those types of purposes, not just your traditional university degree. Estate planning. So estate planning and the gift exemption is now $15 million per year. So it's going up and will continue to go for inflation. So this could be something really good if you are a high net worth individual or have a high net worth family. You may want to consider strategic gifting, but there are also some changes there. Kathy, any notes on these 4 or 5?
The thing with estate planning, what's often overlooked, if you have clients that have a large real estate portfolio, it would be fairly easy to think of it as just the income, like it's not, but it's the value of it that can be taxed when you hand it off to your heirs, whatever happens that you hand it off to whoever it goes to a trust or to you directly to your heirs. The other thing is considering the value of your business. Like if you've got clients that have even other types of businesses with just a little bit of real estate in them, still looking at what their value might be. Sometimes, especially if it's a family-owned business and it's been in the family for a long time, you might underestimate what it's really worth and then get hit with an estate tax liability if something were to happen to you. So it's always important that, Clark mentioned earlier, making sure that you've got a team working with you. That team should include an attorney.
So to kind of recap a little bit, I put this AGI level cheat sheet in here, and this is not black and white. This is not one size fits all. The tax code is really based on your individual facts and circumstances. But based on the phase-out limits, things like that, we tend to see a lot of common threads with people in similar AGIs. So for those people that are under the $300,000 married filing joint, $150,000 single, here's some key strategies or focus areas you can think about. So based on that income level, there's different strategies that may apply to you. So like we said at the beginning, this is not it's not a bill just for the wealthy. This is really for everyone. I will say the devil is in the details. Pay attention to the start dates, the end dates. Are there phase out limits? Is one going to impact the other? There is a whole lot of planning. There are full softwares that just do modeling for tax planning. So if this is something you want to take a deeper dive into, please let us know. Recapping, we went over bonus depreciation, Section 179, real estate professional status, cost segregation, QBI, qualified small business stock exemptions, R&D credits, estate and gift tax increases, plus all of these individual taxpayer changes. So there's a lot happening in this bill, and we're only talking about the tax changes. And even that, we've only scratched the surface. Like I said at the beginning, this is an iceberg. There's a whole lot more legislative changes. There's more for payroll. You name it, it's all in there. We are only focused on the tax impacts. Anyone that attended this, you will get a printout of kind of our summary of these laws. So if you want to review it, see what you think could apply to you, we can also send you the recording. It may take an hour or two for us to get the recording on the website just by the time it loads. Use tax planning as a GPS. So if you're going to drive blind in a snowstorm, you're probably going to get into an accident. You're going to take the long way. You can make your money work harder for you now. So as a realtor, you're working hard for commissions. You don't want to work twice as hard to sell twice as much just because you're floundering it away on taxes. So these are tax strategies specifically changing under the One Big Beautiful Bill. There's other tax strategies we can help you with as a realtor. So let us be your proactive tax planner, help navigate what applies to you and what doesn't, so you don't worry about the fluff. We can be your GPS and help recalculate more quickly. If you have your own tax professional, totally fine. We're still happy to answer questions. I would have you be aware there's two different types of advisors. There's proactive and reactive. A reactive advisor is like a firefighter putting out a fire. But a proactive advisor is like a safety inspector who prevents the fire. So ideally, you should be forecasting ahead what changes are coming. Even if it's only 3 or 4 months, that's still better than just meeting with your tax advisor once a year and saying, okay, what's the damage? How much do I owe this year? There is a better way. So any questions? I'll leave it there for a couple minutes, see if you guys have any questions. If not, our email will be on the next slide or a couple slides from now. Feel free to send us an email. I'll keep watching the questions while I go through here. So like I said, we'll be offering 2 different types of meetings. If you're not a client of Molen Associates or you want to learn more about our services, whether it's tax preparation, bookkeeping, proactive planning, you name it, scan that QR code. It's a free consultation just to get to know you, see if we're a good fit, see if there's anything we can help you with. If not, consider it a free consultation. You can go on your way and keep doing what you're already doing. For anyone that wants to take a deeper dive specifically into the One Big Beautiful Bill and how it impacts them, we're offering discounted consultations. So at $125 for a half hour or $250 for a full hour. Feel free to email us or call us via that contact information, and our customer service team will get you scheduled, get you taken care of. Because like I said, the devil is in the details. The details really, really do matter. We see too many people try to navigate the tax laws on their own. They'll try to do the R&D credit or a cost segregation and they don't have any documentation, or they want to do a 1031, but they didn't get a qualified intermediary, and they now owe $250,000 in tax because they did it incorrectly. It could be as simple as they're trying to do their own bookkeeping and they're disorganized. They're taking too much time. They're losing out on deductions. So professional help is very, very beneficial. Take the time to spend doing what you do best and let us help you with the rest. So if you have any questions, feel free to email us. You can email us at info@molentax.com. But looks like we're going to end right on time. So thank you guys for joining us. Thank you, Kathy, for your contributions, and we look forward to hearing from you.
And we'll very much look forward to hearing from everyone, and anything that we can do to help, we're always here.
Take care, you guys.
Bye.